thank you everyone for joining. It's a great opportunity to take you through this year's medium-term outlook, sustaining returns for the future. We plan to go through this over the period of the next 45 minutes. We will obviously quickly go through some housekeeping, but we will have some time for some Q&A through today. It's an incredibly enjoyable opportunity to take you through this, because last year's one, it's quite interesting to look back on in reflection. What a year it was, 2020, and 2021 is another challenging future, but one where we think sustaining returns for the future. We'll go through some interesting insights that Isaac has for us today. So I might move to the next slide, and obviously just some logistics. I'm obviously the moderator today, and if you have any questions, we have a question and answer button on the far right. If there's any operational or any issues that you want to communicate to me and the team, feel free to use the chat, and we'll obviously look to attend those. There is some audio setting ability for you as well. Look, I won't hold up any more. A very warm welcome to you, and I will hand you over now to Dr. Isaac Poole.
Great, thanks. Thank you, Shane. Thank you very much, and thanks everyone for joining us today. As Shane said, I'll be taking you through our flagship, our all-important 2021 medium-term global outlook. And look, the medium-term outlook that we do is perhaps a little different to what you see from a lot of annual outlook updates. We don't write about what's going to happen over the next 6 months. We don't think really about the next 12 months. Instead, we have a really clear, defined focus on the next 5 years. And we do that because we think that helps us build a really clear roadmap and a really clear set of recommendations that we think will help protect on the downside and deliver returns on the upside over the medium term. And we call that resilience. It's an enormous focus for us at the Portfolio Advisory Service. It's been an enormous focus for the last 2 years, and it's going to continue to be a really important focus for us. This is our third medium-term outlook, and the team and I hope you get some insights from joining us. And just touching on the team, I won't go through and introduce everybody personally on this slide, but this is our team. You can see Shane and myself are based here in Australia. Louise and Florence join us from Hong Kong. They're on the line, and we have a team of 4 with complementary skills, and we've been really happy to put together this medium-term outlook. Before I share with you our thoughts on the medium term, I'm actually going to ask for your thoughts. And I'm going to do that by asking Florence to open up a poll for everybody. I'm going to open up the poll and ask people to share your thoughts on what are the 3 key themes that you think is going to shape the investment landscape over the next 5 years. Are we looking at sustainable and ESG investing? Is it cryptocurrency that's going to be the key theme over the next 5 years? The growth of China? Is it lower interest rates for a longer time? A lot of talk about commodities at the moment, particularly down here in Australia. Is it a super cycle? Is this just a bubble? Is it a sustainable increase in prices? Is it work from home? We've all been doing it over the last year or so. Electric vehicles been an increasingly important topic. Aging population, or is it something completely different? So a useful poll for us to see where you think the key themes are. We'll share the results later. Hopefully everyone's had a chance to vote, and Florence, if you can just close that poll now, we'll take a look at those results down the track a bit. So what we're going to do now is start the medium-term outlook. And before we get to the outlook, I think it's useful to have a bit of a think about where we've come from, what happened in 2020, and we all lived through it. So I'm not going to dwell on it and go through all the economic movements and the market movements too much. I don't think that's all that helpful, but what I will say is that 2020 was a particularly unusual year. We had the global pandemic that led a sharp, brief recession. It's punctuated by widespread lockdowns, by social distancing, the collapse of the service sector, sudden stops in economic activity of the sort you typically only see in emerging markets and frontier or failed states. We saw them throughout the developed world. Equity markets collapsed, credit markets seized up. This time last year, I'm sure you'll remember, but it was getting pretty scary in financial markets. It was a challenging March in 2020. Then we had the Fed and the RBA and other central banks step in with monetary policy, and it was supported by some of the largest and I think most coordinated fiscal support that we've ever seen out of global developed and emerging market governments. And the combination of monetary and fiscal support, in our view, prevented a financial crisis. And importantly, it allowed financial markets to begin operating relatively normally again. And that meant that over the second half of the year, we had growing optimism about the economic outlook. That was fed by optimism about the delivery and development of a COVID vaccine, and that happened, the fastest development of a vaccine in history. That's starting to roll out around the world now. And so, yeah, we had a lot going on. And when you think about at the end of last year, we ended the calendar year with pretty much record losses in economic activity over a 12-month period. This was a remarkably deep recession that scarred economic activity over 12 months. And that meant that it was a challenging year for a lot of investors. Now, last year we presented our medium-term global outlook. It was called Review Resilience and Reduce Surprises, and you can see the front cover here. We wrote this towards the end of 2019. We released it in February 2020. So before the pandemic was really recognized. We'd heard about a bit of a flu in China, but it certainly wasn't a global pandemic. And when it comes down to it, no one expected a pandemic. It was a tail risk event. But in this document, we were prepared for a recession, and it's really important because we found that our medium-term global outlook in 2020 was a great roadmap for improving resilience. It really did provide a set of recommendations at the start of 2020 that were really important for us to successfully navigate markets through the year and deliver great returns for investors. So I'll share a little bit about that 2020 medium-term outlook. I won't go into a lot of detail because, of course, you can access that and reread it. And as a team, we do reflect on it a lot. You'll also get a summary when we send around this deck, so you can read it there. But we made 10 recommendations across 4 key areas that were really transformative in delivering portfolio returns. What I'll make, instead of going through each of these, is that last year our portfolio management success really came because we focused on resilience. And for us, the definition of resilience is protecting on the downside and being able to participate on the upside. And that is something that is always important. It's a critical feature of what we do. And here you can see exactly how we did that. We focused on great portfolio diversification. We knew the potential risks we could face in the portfolio because we used scenarios constantly. We were dynamic, and we were willing to buy equities when valuations became very attractive in March and May. And we were very careful about selecting managers that we thought would protect on the downside, deliver on the upside, and that was the key driver. These 4 areas, these 10 recommendations across those areas were key drivers for us to be resilient through 2020 and again now in early 2021. Now, that's great. I mean, saying that on a webinar in hindsight is really easy. It was, we all know it was not easy back in February last year. It was not easy in March last year. It was a terrible time. Global equities were down 35%, peak to trough. Global credit down 15%. Liquidity was freezing up in the sovereign bond market of all places, and there was nowhere to hide. On top of all of that, we were all managing these risks and these issues from lockdown, or we were working from home, or we were working in a different country. Some of us were COVID refugees, if you like. So it was challenging, and we found it challenging. But here at the Portfolio Advisory Service, we were fortunate to some extent. We had a playbook. We had a series of recommendations that meant that we had a somewhat less harrowing time from an investment point of view. This page just quickly shows the outcomes for one of our portfolios, the active beta portfolio, a growth portfolio that we manage in Australia. We had similar outcomes for an active alpha portfolio and our international portfolios in the growth risk profile. But around this time last year, we experienced drawdowns in March, sort of around 5%. Global equities were down about 4 times that. But that was really important. That resilience was really important in leaving us a strong base to grow returns from, and we're able to do that. We used a dynamic process. We constantly used scenario analysis. It's a critical part of our portfolio management. Our managers, by and large, delivered on their objectives, and we were in constant touch with those, and we were able to deliver really solid returns for our clients in our SMAs and our MDAs and our model portfolios, greater than 13% over the calendar year. You can see that on the left-hand chart, and that left clients with strong performance across any period. And importantly for us, you can see that on the right-hand side, our portfolios are in the top left-hand quadrant. That's where we aim to be. We focus on being resilient. We focus on delivering great risk-adjusted returns, and our 2020 medium-term global outlook really helped us to deliver that relative to our peers in the comparable Morningstar peer group. So that's just a quick review of where we've come from, where 2020 was, and now it's time to start looking forward at 2021. Here we are, 12 months later since that 2020 outlook. We delivered on resilience. We've moved past the recession of last year. It's time to start thinking about sustaining returns and the themes that are going to help us do that. Before we do that, let's take a look at the poll results. If Florence, if you can put them up, let's see. Right, hey, this is really great. So overwhelmingly, the view is sustainable and ESG investing is going to be critical for sustaining returns over the next 5 years. The growth of China, low interest rates for longer is next, and then pretty similar outcomes: work from home, crypto, aging population, sort of share that, and then we've got no one's buying Tesla, commodity super cycle down the bottom. So interesting results. And what I think might be of interest to everyone is a lot of the themes that you're thinking about are ones that we're thinking about. A lot of those themes that you think are critical to driving returns are the ones we're thinking about. And here they are from our 2021 outlook. The 5 key themes we think will shape the investment outlook. The 5 key themes we're focused on for the next 5 years that will be crucial in delivering on a commitment to great returns and sustaining returns into the future. The start of a new cycle, using scenarios to manage surprises, searching for yield in a low rate environment. The growth of China, we think, is very important, and sustainable investing. And I'm going to run through each of these in turn. We'll go through why they're so important. We'll share how you can use these themes, some recommendations, if you like, for how you use them to drive great returns, and how we're going to use them to drive returns in the Portfolio Advisory Service portfolios. So let's look at the first of these, the start of a new cycle. And by a new cycle, I mean we've just reset. The recession we had, accommodative monetary policy, the far-ranging and incredibly strong level of fiscal policy fiscal support that has been implemented by global governments, developed markets, emerging markets. In our view, this has put us back at the start of a new economic cycle, and that is important. We think that this is going to be a cycle of relatively low and contained inflation. And we think that inflation is going to be contained by a range of things. Low household income growth. It's going to be contained by aging populations. It's going to be contained by improved productivity coming through from technological progress, and we'll touch on that later. But that low, that disinflationary pressure, if you like, low inflation, it's going to allow central banks to leave rates low, very low, for a long time. This is a low rate environment, and that's a critical part of our outlook. But right now, I'll just say that low rates mean that we're in an asset reflationary environment. In our view, that is, risk and growth assets are likely to perform well. And about that, I'll make 2 points. First, we think equities will perform well over the next 5 years. We saw that at the back end of last year. Equities performed very well. They were supported by monetary and fiscal policy, but it's not just relying on equity beta. It's not just dumping money into a broad equity index and expecting to deliver great performance. It's going to be very important where you get that outperformance from. And as an example, in 2020, Chinese equities outperformed the global equity market by about 1,000 basis points over the year. That's a fairly significant level of outperformance. Making good allocations, understanding about China, understanding the dynamic movements in global equities, it's going to be critical for helping grow capital and critical for delivering outperformance. Second point I'd make in this environment is that there will be bouts of volatility, and managing those will be critical. The medium-term outlook is positive, but you can expect market turmoil. We've seen that over the last month or so. It's going to happen. It is going to be really critical in this environment where there's tailwinds for equities to be able to look through near-term turmoil, to look through near-term volatility and focus on the fundamental upside. And that is where we can help. We have a clear track record in managing that, in looking through the medium term, our 5-year outlook, our 5-year dynamic process, helping to deliver outperformance and really communicating through that near-term volatility, the medium-term outlook. We find that really critical. The next theme, the next critical theme for us is using scenarios to manage surprises. Now, this was a recommendation that we made last year. We said that scenario analysis is a great way to help promote resilience. Now, I guess I'll make this point. When I read the typical annual outlook or the 1-year outlook that comes out at the start of each year from banks or from analysts, I'm always really struck by comments, and they come everywhere. The outlook is uncertain. Uncertainty is elevated. Now, these are absolutely true statements, but the point is that they're always true. It's nothing new. There's no information from making that comment. Yeah, uncertainty is there. We're investors. We work in markets where there's no perfect foresight. So uncertainty is a constant companion. And for us, we believe in embracing that. We don't need to point it out. We know it's there. We believe in dealing with it. And how do we deal with uncertainty? For us, it's using scenario analysis to check how portfolios might perform through a range of plausible outcomes. And those outcomes are ones that we think aren't necessarily tail risks. We do tail risk scenarios, but we focus on plausible outcomes that could eventuate over the next 5 years. And right now, we have 3 plausible scenarios that we're carefully managing. I'll touch on them very briefly, but there's a lot more material on this if you're interested, and interested in how we quantitatively run these stress tests. But the first is an inflationary shock. And that inflationary shock is one where inflation surges over the next 24 months. Central banks are forced to hike as a result, and that has an impact on the economy and on markets. The second scenario is a tech boom. And that's one where technological progress helps improve both medium and long-term growth potential that allows rates to stay even lower for even longer, because the increase in productivity is ultimately disinflationary. And then we have a worsening in US-China trade relations, and these are not great to start off with. So worsening from there is clearly a negative scenario. The economic recovery stalls, global trade weakens, global supply chains tighten, and we have a challenging environment for some time. And you can see on this slide that the inflation shock and the China-US trade war scenario are bad for both equities and growth. We think that they're very bad for equities and growth, and so that means that they are material changes to the outlook and ones that we need to keep track of carefully. The tech boom, on the other hand, and our base case, the start of a new cycle, are positive for both growth and equities. Now, that doesn't mean that we just focus on the great ones and ignore the poor ones. Obviously, what's really important is that while we think we're pretty good at forecasting the medium term, and that's where we focus our time on, the reality is the world changes. It changed last year, resulted in considerable losses for a lot of investors, and you need to be able to prepare for that. That doesn't mean building a portfolio for a recession, but it means using scenarios to carefully manage the outlook and prepare for the upside, prepare for the downside, deliver strong returns, and we intend to keep doing that. And it's a really critical part of our portfolio management process. The third theme is searching for yield in a low rate environment. Now, we know interest rates are low. We all know that. They're lower than they've ever been. In some cases, they're negative. Central banks globally have made it, I think, abundantly clear they intend things to stay that way for some time. And it's going to be a big challenge for investors and for savers, something that investors and savers have been learning to cope with over the last decade since the GFC. But the reality is right now, if you're an investor, you cannot just turn to the safety of cash, to the safety of term deposits, and expect to get some sort of return for your low risk. You're getting low risk, but you're getting no return, effectively zero return for that low level of risk. So we make the point here that for savers, for investors, term deposits simply do not cut it. Let's have a look here. I've grabbed a conservative term deposit rate from a major bank in Australia. Look, you can go on and find some that are somewhat higher than this. You can certainly find many that are much lower. But the point is, if you stick $100,000 into that term deposit, leave it there for a month, you're going to have $500 in income. That is not a pathway to retiring with dignity. It's not going to be a livable income. It's not going to keep up with inflation. You are going to lose money in real terms. So you need to consider other options. And what are those other options? When you're managing income, when you're managing yield, when you're managing downside risk, this is not an easy environment. So what do? Perhaps you go to sovereign bonds. Maybe you buy some investment grade credit. Maybe you go out the risk curve to high yield debt. You may have some thoughts about alternative credits, and all of these are important options. But the further you move out the risk curve, the more experience you need and expertise you need in using them for different parts of the portfolio. And I think that's really critical, because they are increasingly risky as you move away from cash. And we're very fortunate with the portfolio advisory service. We have a range of great managers that we use. Some provide income, some for return, some for a manageable level of risk. But more than anything, I guess the point I would make that when rates are this low, and they're likely to stay low for a long time, this is going to be a critical part of portfolio management over the next 5 years. That means managing risk, managing returns, managing liquidity, and managing resilience. And I'll say it again, just because I think it's critical. Look, the risk-free rate is effectively zero or negative. You can't rely on it for protection and returns, and that means something is going to change. And for investors, they're going to need help with that because you need increasing expertise to be able to cope with those more risky assets. The next theme is China, and I think living here in Australia, we know that we've become increasingly familiar with China because of our geographical location, and that's important because China is enormous. It is impossible to ignore its influence in our global politics. It's influencing global economics, in regional geopolitical outcomes, and more recently and importantly for us in financial and capital markets. And it will be, in our view, one of the critical themes over the next 5 years. So here we have our 1, 2, 3 of China. So 1, China was first to exit recession in 2020. Now that's because China has lots of policy levers that helped it be the first economy to exit recession, despite effectively locking down large parts of the country when the virus was really first identified as a critical risk. 2, China has the second largest economy and the second largest equity market globally. It is a serious player in terms of economic growth. It is a serious player in terms of economic capital and financial market capital and financial market flows. And 3, despite number 1 and 2, which are important, foreigners own just 3% of China's domestic A-share market. That is when they are owning China. And that means this is a seriously structurally underowned market. So somehow, despite China growing and the rising importance of China to the global capital and economic markets, and the fact that China has been liberalizing access to its financial markets, it has been somewhat ignored by investors. And this is happening at the same time that China's representation in global benchmarks has been increasing and will continue to increase. Now, as a team at the Portfolio Advisory Service, we've been covering Chinese markets for a long time. As a team, we've got people based in China, and we've been doing this for more than a decade. And we believe that investing in China is really important for diversification and really important for alpha generation. But it's a volatile market, and you can see on this slide just how volatile. These are the annual returns over the past decade. They've been anywhere from between minus 25% and positive 55%. That is volatile. Now, that is part of Chinese markets. They are liberalizing, they're changing, and we have experience managing that volatility. We actively allocated to China and Asian equities to great effect within the portfolios in 2020. We think that this will continue to be an increasingly important part of delivering excess returns over the next 5 years. But it's a specialized area, and it's something we have experience with in the team, given my background of 6 years working in China, the team's background, and our experience with Chinese asset markets. Our final theme is integrate sustainable investing. It's the number one theme identified by you in the poll. It is big. It is increasingly an important topic. It's something that is not going anywhere in our view. Now, we talk about sustainable investing, including ESG investing, including impact investing, including climate change and green investing. It is going to be one of, if not the biggest themes in the investment industry over the next decade, we think, and that is being acknowledged, and it's and investors' actions are acknowledging that. ESG related assets managed in the US grew more than 40% from 12 trillion US dollars in 2018 to 17 trillion by 2020. You can see here Deloitte expects it can grow 3 times faster than non-ESG related assets, taking the total to about $35 trillion by 2025. That is phenomenal growth. Ignoring it is not an option, and people are not ignoring it, which is great, and we are not ignoring it, which is important. And I'll tell you why people are not ignoring it and why it cannot be ignored. It's because there is loads of research out there that indicates sustainable related investments can help deliver and will deliver excess returns, will deliver alpha over and above non-sustainable investments of between 2.3% to 4.4% per annum. That is telling you that if you choose to ignore sustainable investments, you are potentially throwing away excess returns, you are potentially giving up alpha, and that is not something as investors we want to do. So it is critical. We are here to help with sustainable investing, understanding the benefits of sustainable investing, and having beliefs and belief structures around sustainable investing is something that has been a core belief and a core part of our investment philosophy for several years. We've incorporated into our portfolios with great success. And importantly, we'll be sharing more information on how we think about sustainable investing, what that means for investors in a white paper that we've completed and will be released to the broader public and our clients over the coming weeks. If you are interested in that, please get in touch with us, jump on our website, jump on LinkedIn, send us an email, and we'll make sure that you get a copy of that when it's released. So there it is. That's our medium-term global outlook. We're looking out over 5 years. We're looking at 5 key themes, 5 themes that we think are going to be crucial to sustaining the great returns that we achieved from 2020. Below those 5 key themes, there's 14 really clear and really actionable and implementable recommendations that are detailed in the medium-term outlook itself, which you'll get a copy of as part of this webinar, and you'll get the recording and you'll get the deck, and you'll be able to take a look through those key themes. If you have questions about the global outlook, our discretionary portfolio performance, SMAs, MDAs, our approach to sustainable investing, then please get in touch with us here at the Portfolio Advisory Service, and we'll be very happy to help. But with that, I think I've just used up my allotted time. I'm going to pass back to Shane to see if we've got any questions.
Thank you, Isaac. And yeah, great presentation. Look, I'll just remind everyone, there is a button there for Q&A. So please send through. You can just send it straight to the panel members, and I'll obviously moderate, keeping an eye on those as you send them through. So we've got looking at the time here, we've got another 10 minutes. It'd be great to get some of your questions. So yeah, feel free to send them through. Look, I might just open up maybe with a question, Isaac. In Australia, there is a lot of strategic asset allocation advisors. And I think dynamic asset allocation clearly is a different process. And there are clearly a lot of benefits as well. Having a look at something like this over a 5-year view, over the medium term, there are some really key themes. But could you take us through what is dynamic asset allocation, and how would you use these themes in managing a portfolio going forward?
Yeah, so in our view, our dynamic asset allocation process links up to our medium-term outlook really, really tightly. As I said at the start, our medium-term outlook looks out over 5 years, and our DAA process is explicitly a 5-year process. What we do is we look at the outlook. We think about what the market is discounting or what the market is pricing. We look at our key themes and where we think markets are going to end up. And if there's a material mismatch between those two, then we can make a dynamic tilt that we think will play out over the next 5 years. So it's not market timing. It's not trying to time markets. It's not trying to make lots of changes or prop trade portfolios. It really is about identifying material mispricing and implementing that, and then managing that dynamic position over a 5-year period. When I look here in our medium-term outlook, what's that saying? I think it's making a few. I think there's a few key points, and our readers and attendees will be able to have a look at these in the medium-term outlook. They come through in our recommendations. It's thinking about what sort of fixed income or fixed interest exposures you want to hold in a environment that is positive for equities, likely to have sovereign bond yields drift higher, for example. How do you continue to have some downside protection in that scenario? And we think that sovereign bond yields, for example, will move higher. That will be a challenge for the asset class, but they're a critical part of downside protection for a retail portfolio in particular. So that sort of dynamic position and thinking about tail risk hedging is really critical in our medium term portfolio management process.
Thanks, Isaac. Yeah, I think it's an important point. These are key themes, but in terms of the portfolio construction, there's quite a lot of other key strategies that are deployed to provide a diversified portfolio. And I think you called it well last year with regard to the focus on resilience. So protecting on the downside and participating on the upside. And things never go in a straight line. It's uncertain, as you say. So dynamic asset allocation will continue to be an incredibly important part in terms of risk management and managing portfolios. Now, we've got a question that's come through, so thank you for that. And the question relates to views around the broader emerging markets. So China, as you've highlighted there, is a key component of this year's medium-term outlook. But just looking beyond that, is there any other parts of broader emerging markets that could be a beneficiary as the questions come through in relation to population and urbanization growth?
Yeah. Great question, and I think this is a particularly critical area. Emerging markets are a collection of different countries that are lumped into one sort of classification for ease, for the purpose of ease and to make it easier for people to understand, but they're not the same. They're very different. Emerging markets in Latin America are not the same as emerging markets in Eastern Europe or in Africa, and they're not the same as emerging markets in Asia. There are different drivers. They have their own idiosyncratic risks, and they also have very different equity market sizes. And that means that if you're thinking about a broad emerging market index, there are a lot of countries that are very underrepresented, and some countries like China that are the major part of that index. Now, we think that over the course of the next few years, the macroeconomic environment will be one that will be particularly positive for broader emerging markets, but in particular for the Asian region. And we think that because we think China has a lot of growing to do and will be a key driver of the economic recovery over the next 5 years. And that will mean that countries that have very close linkages, close trading ties, close geopolitical ties are going to benefit. That happens to be the Asian region. That's not to say that Latin America won't do well. We think it will. But as has been the case over the last few years, we expect the underperformance from Latin America and from Africa, for that matter, to persist relative to Asia. So that theme about the rise of China is very important, because it has helped drive our broader emerging market view, and it's helped turn our focus back in towards the Asian region, where we think the best opportunities lie.
Thanks, Isaac. And another question's come through, so thank you. Keep sending them through. Appreciate your questions. The next question that's come through just relates to inflation. I think the last couple of quarters has been incredibly interesting with regard to just quite simply the US 10-year bond yield and what's happening globally in relation to people's view around inflation expectations. So the question then is, what is your view on inflation, and trying to separate it from this short-term versus medium-term perspective?
Yeah, it is probably over the last few weeks, maybe last 2 months, the biggest question that a lot of portfolio managers, a lot of fixed income and investors are trying to grapple with. Where goes inflation over the next near term and the medium term? We've observed disinflationary pressures and low inflation for the best part of the last decade. And to put it very succinctly, we expect that to persist. And there's a lot of structural drivers of disinflation: aging population, increasing productivity. These sort of extent, and we think we'll see labour market slack persisting, and that may not show through in the unemployment rate, but in the underemployment rate in the US and globally. These sort of structural impediments to higher inflation seem set to persist, and that's something central banks have been grappling with. They've really struggled to get inflation back to their targets, despite interest rates being flat on the floor for the best part of 10 years. We think what you're seeing at the moment is inflation expectations normalizing. That's great. It's really important. It's important that central banks can make sure that inflation expectations are anchored somewhere near their targets. We're not back there yet, but they will continue to leave shorter dated rates flat on the ground to promote that. What's sort of been going on in the fixed interest and the yield space at the moment, with nominal yields at the longer end driving higher? Initially, that was reflationary expectations, and we think of it as being normalizing inflation expectations over the near and medium term. Critically, over the last month or so, you've seen the real yield, the inflation-adjusted yield, start to drift higher as well, and even outperform nominal yields. That means that break-evens have pretty much, break-even inflation expectations have flattened out. That's a great outcome for central banks. It means that they're getting a handle on inflation expectations. It's a great outcome for the economy because it means real growth expectations are picking up. And to be honest, we think that we're going to see yields continue to drift higher in line with normalizing inflation expectations, in line with better economic outlook. And that really does feed into the tailwinds that we were talking about earlier around growth assets.
Thank you, Isaac. Look, we've literally got about a minute to go. I'm conscious of people's time and really appreciate you joining the session today. One last one that's just come through. Just, is there any concern around credit markets or private credit, given recent unwinding of Greensill portfolio?
Yeah, I mean, it's a great question and really important. Private credit markets, alternative credit, these are areas where you need deep expertise and a deep understanding of liquidity, the underlying markets. The due diligence requirements are extremely high. They are not areas to go into lightly. We've seen issues in these markets with liquidity problems during 2008 and 9. We've seen them again recently. So a couple of examples of that. And that means that you should not enter lightly. From our perspective, alternative credit, it can be a source of return. that requires elevated expertise in reviewing them, elevated manager research expertise and skill and experience in really getting to the bottom of what's driving that, looking through the manager, looking through their processes, looking through their philosophies, and getting an extra level of comfort that they can fit into the portfolio. Now, they will not fit into every portfolio. They may be useful for some clients, but again, I can't stress enough that they are an area where you should spend a lot of your research budget, a lot of your governance budget on checking that. And I guess I'd make the point that, with Shane on board at the Portfolio Advisory Service, one of Australia's, I think, most experienced and best managed researchers, we are well placed to be able to help clients with this and to have a really deep understanding of that asset class for investors that are interested in taking a look at that.
Thank you, everyone, for those questions, and thank you for the presentation, Isaac. Look, just in summary, I just want to reflect on 2020. As Isaac put it, was a particularly unusual year. We at the Portfolio Advisory Service, we did focus on resilience, and for us it meant protecting on the downside, but also participating in the upside. There was nowhere to hide. There was lockdowns and it was challenging. But I think what was incredibly important for us was the ability to turn to our framework and to have a playbook, as Isaac had called it, using scenario analysis, etc. But 2021, there has been a reset. There is a new economic cycle in our eyes. It's low rates for longer. There will be continued search for yield. China is an incredibly important market, and the growth there is going to be a key factor in the years ahead, as is sustainable investing. And Isaac did reference a white paper that we've done there, so we would be very happy to share that with you in the next couple of weeks. Thank you very much for your attendance today. We will be sending the recording of this session along with our Outlook paper to participants. If there is any interest, so people out there, if you are looking for some consulting expertise, please obviously reach out to us in our communications. We've got website and you can find us there. We'd welcome a conversation with you and look to try and understand your needs and provide our services to best meet those. Once again, thank you very much for your time today. We hope you do enjoy reading this year's 2021 market medium-term outlook. Thank you very much.